So, hi everyone. Today we are starting up with a new series of webinars with all the fund managers in the industry. This would be beneficial to get deeper insights into the markets, what's happening around the global markets, and which market cycle are we currently in, and what are the different economic cycles we are into. So, all these are the things that we will be talking with different fund managers out there. So, today is our first webinar with Mr. Arun Chulani, who is the co-founder at First Water Capital. So I'm very grateful to him to be on the board with us and start with our first webinar. So here you go. You can watch the entire webinar, and in the meanwhile, if you have any questions or anything that you want to ask directly from the fund manager, you can comment in a below our video, and we'll happy to answer that. Thank you. So, hi Arun, welcome to Bharat Alternates. It's very warm to welcome you here, and this is our first webinar with First Water Capital, and Arun is the co-founder at First Water Capital. So, maybe Arun, if you can start over by giving a little professional background about yourself, and then
Sure. Well, thanks, Gatanch, for the opportunity to speak to you. As mentioned, my name is Arun Chulani. I'm one of the co-founders of First Water, and we're an Indian equity fund. I started my career, I think, more than 20 years ago. I graduated from the LSE. I went on to Arthur Andersen. I went on to Lloyds Bank, Ernst& Young in their corporate finance division. And prior to First Water, I was in a private equity house managing over $500 million. But in 2018, we started First Water, and we are a long-only equity fund focusing on Indian equities. The key guy is a gentleman called Ricky Kirpalani, and he's been in the market for over 30 years. And really, for him, it's been a case of so far so good. But looking forward to dive in to him as well as First Water as and when.
all right. So Arun, I just wanted to also have a question from you that what was the inspiration of you starting First Water Capital? Because you were, I think, already doing well in London and in Dubai. So what was the inspiration to start First Water?
Sure. So I got reacquainted with Ricky in 2016, and I was in private equity, and I thought I was, I thought I knew some stuff. But when I met him again, I was just like blown away. I mean, he is so articulate, understanding of the equity markets. It was really as though a veil had been lifted. And he said, "Look, whatever you're doing is wrong. This is how I look at equities." And he went through the process, what kind of stocks he looks at, the way he does it. I mean, over a lunch, so there's only so much. But I was just blown away at the way he looks at things. The type of sectors he picks, the way he values it, and what is the upside and the asymmetry. Everyone's looking for this elusive alpha. But when he looks at the stock, he's not looking at like a 20 or 30% up or down. He's looking at 100, 200, 300. And this was like unheard of from my perspective. So I went back, I tried to reproof it, and effectively, I invested a bit. And fortunately, 2016 and 17, the bull market happened. So I had an opportunity to really see these valuations get unlocked, and not just in a small way, but in a very strong way. And from then on, I was pretty much hooked. I'd always meet him. I'd say, what should we do? What are you doing? What are you investing in? How do you look at this? How do you look at X? How do you look at Y? So I was very curious. Eventually, he said, if you're really that interested, let's start something. So I went off and I started like the structure, and that's where we kicked off in September 18.
Great, great. All right. So now I would, if you can run through you primarily run your AIF, which is Alternative Investment Fund in category, which is a category 3 AIF. So I really want that. I was also watching your video where one can how to become a value investor or how to choose stocks like a value investor. So maybe
Mm-hmm.
you primarily follow these kind of strategies where, I was just reading on your website also that you pick a manufacturing, consumer discretionary, these kind of themes, and the company which is also going through some cyclical change, right? So it would
Mm-hmm.
be good if you can run me through your AIF and what is you finding interesting in these kind of market scenarios where market looks expensive, but some people says that there are a lot of opportunities in the market as well. So how do you see all these kind of things? And if you can run through your AIF also before moving on to the markets part.
Sure. So in total, we're managing over 1,300 crores across our vehicles. And I mean, just to lay out the credentials, our FPI, we have two structures. We have one FPI, we have a couple of AIFs. And we started the FPI in September 18, and we started the first AIF in August 2020. So different starting points, but both are doing pretty well. So if you look at the FPI, our 3-year dollar CAGR is about 25%. Our 5-year dollar CAGR is 34.7%. If you look at the AIF, our 3-year CAGR is around 30.2% repeat terms. So both are doing pretty well. And if you step back, if you look at Ricky's performance before starting the fund, we got a Big Four consultant to review his performance. And from 2002 till 2017. So you've got the anything in the garden and the kitchen sink thrown at him. From the crash of 2008, taper tantrums, changes in governments, coalition governments, oil was high, oil was low. So all types of scenarios in terms of all weather patterns. And
Mm.
he took a pool of capital from around 15 crores to over 1,100 crores. So from $3.15 million to $174 million. So that's a dollar CAGR, including the repeat depreciation, about 30.7% and a multiple of 55x. And fortunately, through his methodology, the funds have been also reflecting that approach. So how do we do it? Everything very much centers on investment philosophy. You've got to have a philosophy to ensure that you're able to withstand the volatility. So we are long only. Why is that? Because taking a short position effectively, the asymmetry is not in your favor. Because what are you going to get trying to short a stock? You may get 30, 40, 50%, or you may take leverage. But there's a limited downside where there's an infinite upside, theoretically. So we don't want to take those picks, and the market can stay irrational longer than you can stay solvent. So that's why we take long. Of course, we're India centric because India is experiencing a lot of tailwinds. Of course, today, you got tariffs, you got geopolitics. Everything is seemingly happened, but hopefully this will all settle down as we've seen in the past. Whether it's a COVID, whether it's long-term capital tax, whether it's government changes, we have to endure, but we still have very strong tailwinds, and we're looking to invest into them. So very much we look at the long to medium term. Then we're value guys. And we're not just there looking for cigar butts. India has over 5,000 stocks that are listed. We have a universe maybe over 1,400 stocks. So effectively, we're looking for good value. So there are a lot of value stocks that may be trading under book value, but effectively they may just be sitting there for a long time. Maybe they're structurally impaired. Maybe they're holding companies, or maybe they have a lot of cash but no capex plans. So you've got to really try and identify what is the unlock. So as you mentioned, it could be the turning of a business cycle. It could be a government announcement. It could be overlooked growth that's overlooked by the market. So effectively, you're only looking for a handful of stocks, but the catalyst is that change in earnings. Because as you know, stock price and valuations generally follow earnings. So you're really looking for that turning point. And it may not happen immediately. Businesses move not at the same pace of a stock price. They take 1 year, 2 years, sometimes even 3 years to adjust for the business cycle to run out. So again, you have to constantly monitor. It's very rare that you can time it to perfection, but at least you can monitor the approach and you can allocate accordingly. Then we like concentrated picks because again, you're only looking for a handful of winners. You're not looking at 50, 60 stocks. Because if you're typically looking at an upside of 100, 200, or X percent, and you buy 2% of your position in a single stock, then even if it doubles or triples, the impact is going to be muted. So if you really like a story and you really like a pick, effectively you might as well take a big swing at it. And essentially, we're effectively, so that's the concentration. So those are the various steps that we look at. And then it gravitates, at least for us, towards balance sheet heavy businesses. Why is this? Essentially, it's easier to triangulate. You can triangulate the balance sheet to what it can produce. So if you're looking at steel production or steel production, essentially, rule of thumb, it costs about $1 billion to put up 1 million tons of capacity. So suddenly you know what should be on its balance sheet. You know what should be on what its revenue capability is. You can triangulate against its peers in terms of revenue per ton, EBITDA margin per ton. And then you can say, what are the nuances? What are the differences? And can it work it out? Or is it experiencing better profitability or better tonnage? And again, why? So you're able to essentially triangulate a lot easier. Also, they never run away too far away from their balance sheet. If you've got a steel company trading at 5, 10 times book, then it's, probably a bit overvalued. Whereas if you're looking at your new age, your tech companies, they could be sitting at 50 PE, 100 PE, or they could have a huge valuation and they're not even making profit. But what do you triangulate it against? You can triangulate it against its peers, but what's to say the pack shouldn't be 80 or 50 or 40? You're very much at the mercy of perception. Whereas in the balance sheet heavy type businesses, you at least gravitate around the balance sheet. And also, we gravitate towards small to mid caps because our belief is large caps are priced to perfection. You know, big investors are forced to invest in large companies, so liquidity flows to them. A lot of analysts, hundreds of analysts, will look at your large cap stocks. So information is easy. But as mentioned, there are over 1,500 stocks that we are able to look at in our universe. So if we look under the surface, we're really there looking for the more obscure, where information is harder to get, where it's not really understood, and what's hopefully been overlooked. Because again, we're just looking for that handful of gems that will create alpha. So that's very much how our approach really works.
Great answer, Arun. Thank you so much. So now, just there was one more question in my mind. What is the average market cap that you look for? Because you are primarily investing into mid and small cap companies, which can become market leader going forward. So, what is the average market cap that you look at?
I mean, we don't look at the average, but we look at generally anything over 1,000 crores. So we want liquidity. We're not looking at the micro and the ultra small caps because given that we're a liquid fund, we want to have that liquidity. So if it's hard to get in, we probably won't get in because if it's hard to get in, it's pretty hard to get out. So generally anything over 1,000, but we're flexi cap. We can continue, into billions of dollars effectively.
All right, great. And how do you see the Trump is imposing a lot of tariff on Indian imports? So how do you see that? Is it a short-term kind of a thing, or do you see that it would be affect a lot of companies, like the companies primarily who are, into import export? What kind of impact do you see here?
I mean, the $1 million question, what Trump is going to do. And I don't think anyone knows, probably not even him. So, today he'll say X, tomorrow he'll say Y. So effectively, you have to take it, you got to be cognizant that these situations are happening and there will be volatility as a result of him. But at the end of the day, India exports about 87 billion dollars to America, which is around 2% of our GDP. So let's say, looking at a bird's view, at a helicopter view, hopefully it's not going to have too much impact if that 2% goes to 1%. But again, for those companies, where it's the jewelers or the textiles or whoever's actually impacted, that's where the real impact's going to be. So you don't really want to be positioned there and at the mercy of geopolitics. So again, he could change his mind tomorrow. India can stop buying Russian fuel. Many things can happen, but we don't want to be too much at the mercy of this because, like I said, anything can happen. Um, and and also we're not, India was also, let's say, trying to position itself as a China plus one. So not being able to export to the largest market in the world is not something that we were looking forward to. So again, we were hoping to build out. We've had a lot of successes in terms of, for instance, Apple and Samsung and Nike shifting part of their production from China to here because his initial target was China. So it's not the best thing to have happened, but hopefully it'll unwind over time. So we really have to take a sanguine look at things, perhaps not be so reactive, and just look ahead. I mean, his presidency is maybe 3.5 more years. Obviously, no one's, that's still a decent amount of time. But effectively, you've just got to have that long-term perspective that as long as you're not 100% in these export industries, then you can take a sanguine approach. And India is still one of the fastest growing major economies today.
Right, great. And there is one more thing, like you primarily pick something from manufacturing. Not primarily, you try to hunt for manufacturing and consumer discretionary kind of businesses. So there has been a major bull run since, after I would say post-COVID. So do you still think that manufacturing and consumer discretionary will play a huge role as India has to grow from say 3 or 4 trillion economy to a 10, $15 trillion economy? So what kind of scenario do you see here?
I mean, definitely. I mean, India is really the stock market. If you look at the index, sure, people say it's overvalued or it's always been overvalued, but India is very much a tale of two cities. You still got those hi-fi, high valuation type stocks that are buoying up the index. But for instance, when we look at our portfolio, our price to book is about 1.2. Our price
Okay.
to earnings is about 16.8. And that's still a little high because some of our companies are sometimes loss-making, so they may pull up the ratio. So effectively, you only need a handful of gems. You're not looking for 50, 60. You're looking for that handful of gems that are going to make a difference, that you believe are undervalued, that you believe their intrinsic value is much bigger than the market cap or the market value. So effectively, it just takes a lot more work to try and find that handful. And you've got to have the patience because, as mentioned initially, market cycles just don't turn because you bought into them. A lot of things, take place, or capex takes a long time. So you really just have to have that patience. You have to run with the dynamics, and you got to have other processes in place to ensure that you're not just holding and buying and holding effectively.
All right. All right. And what about the industrial, commodity, and the utility sector? How do you see these kind of sectors where there is a lot of cyclicality in nature? Some there are some years when these sectors, go in uptrend, and after a couple of years they are into similar phase. So how do you
Yeah,
see these sector?
definitely. Good question. So yes, I mean, there's a lot of cyclicality because there's the aspect of demand and supply. When times are good, people, increase capacity, and that causes a fall in prices, and then the price times are bad again, so no one does capacity. But effectively, that's just a simple business cycle, boom and bust scenario. But India itself is growing, isn't it? We got 1.4 billion people. They're aspirational. Today, our average GDP per capita is about 2.7 thousand. Hopefully, by the end of the decade, it should be almost 4 or 5,000. So effectively, that's an increase in discretionary spend. That's an increase in demand, whether it's of infrastructure, of vehicles, of FMCG products. So all this is a push, and we are, as mentioned, growing at 6, 7, or 8%, as mentioned. And we need a good infrastructure. So steel, cement, all these things have a structural growth. Sure, the price may move up and down according to the business cycle, but over the next 10 years, over the next maybe 15 to 20 years, structurally, on a volume perspective, they should be growing in order to accommodate our increased demand, which is population driven. I mean, if you look at steel production, in 2020, we had 100 million tons. So that means, no, no, yeah, around 100 million tons. That means in the 75, 76 years since the British left, it took us 76 years to put up that 100 million tons. Today, we're at more than 140 million. By the end of the decade, we should be at 200, 240 million if the forecasts are correct. So that means within 10 years, we are more than doubling what has taken 76 years to build. So that's what I mean by structural growth. we are at that inflection point where we need a lot more. And structurally, on a volume wise, we're getting more demand because of the base effect and because of the large population.
All right, that's a very good answer. So, apart from that, I also was focusing on what kind of sectors, apart from the sectors that we have talked about, is there any other sector that you think is going to play out in next 3 to 5 years or maybe 7, 10 years in India that we are missing out right now? So, is there anything that we are missing out on? Maybe we haven't
I
touched.
don't know what you're in. So how do I know what you're missing out on? But of course, I can only speak for ourselves. But of, what do we like is, I mean, the infrastructure story. In 2019, the government announced 1.5 trillion towards infrastructure spend because if India is going to become this third largest economy in the world, we need the infrastructure to support it. We can't just imagine one goes out without the other. Then in 2021, they followed up with another 1.2 trillion. So suddenly $2.7 trillion, which is almost the size of the GDP of India, probably as big as, a lot more economies, is going into all this build, whether it's airports, highways, port renovations, all these aspects. And you can see it. So for instance, we have more than doubled our number of airports since 2014. Our number of highway kilometers has increased by more than 69%. So it is, the realization is there, the growth is there. So this also pulls in 100 different industries, whether it's the chemicals, the steel, the metals, the mining. All this is pulled in by infrastructure. So for us, this is a good push. And as mentioned, it's a business cycle. It doesn't go up in one line. It'll go up and then it'll come down and then there'll be crunch points. So there's always, I mean, not always, but there are good opportunities to enter effectively at certain points of time, according to us. We also quite like the packaging sector. Again, there's a big concentration or there's a joy, let's say, on the FMCG story, because here you got 1.4 billion people, and as they get richer, the aim is that they'll move towards branded goods. But if you're looking at, all the brand names, Colgate, Unilever, Procter and Gamble, they're generally well priced, whether it's 30, 50, sometimes even 80 PE. But for us being value guys, that seems a bit too rich. But we looked across the value chain and we identified flexible packaging. So effectively, why do we like that? Because sometimes you can buy these companies at less than book, and yet they're growing as fast as their underlying clients. Because when you buy your crisps, when you buy your chocolate bars, your cheese, it's generally wrapped up in flexible packaging. So it's growing fast as their underlying clients, if not sometimes faster, because a lot of these guys have gone overseas. So that way they can grow faster. So effectively, they got strong growth and they're available in the market at decent valuations. So again, this is another area that we quite enjoy. A number of other sectors, whether it's steel pipes, and so on. Again, it's maybe a subset of infrastructure, but that's generally where we've tended to focus on.
Right. In the meanwhile, we were talking, I was just checking the data that you are quite much, if we talk about the number of airports, because airport is something which supports again infrastructure. So I was checking the data, the number of airports if we have in India is around 150, 200. In US, it's 100 times more than what we have in India. So obviously there
Hmm.
will be a lot of opportunity in the infrastructure sector, right? So now we are entering just the last part of the webinar where we will be discussing about the global markets. So like Arun, you travel a lot. You have worked in London and then you have worked in Middle East. So if you can throw some light on what's happening around the global equities and maybe a little bit about the debt markets, that would be good.
Debt markets, I wouldn't really know too much, but I can just give you a kind of like layman's view. I always reserve the right to be wrong, but I mean, why is our focus is on India, just for perspective? Because it's one of the best performing markets over the last 20 years. We're a broad-based market, so a lot of stocks, a lot of companies are doing well. Whereas, again, from a layman's perspective, if you look at America, a lot of their performance depends on the Magnificent Seven or the heavy, large tech companies. But if you strip them away, they're doing okay. It's not doing, as amazing as you look at the index as a whole because of the large gravitas of these large stocks that are doing pretty well. So I mean, I would stick to India. Again, Europe, it's had a good year. But again, over the long term, Europe has its own structural issues. It's a mature economy, it's an aging economy. China is well valued. Again, very, very laid man. It has good valuations, but this it hasn't got anywhere too fast for the last 15 or so years. So why do I want to take a bet? What's going to be the unlock? Again, it's caught in the crossfires of geopolitics. So that, Japan's doing very well, seemingly because of the yen and the fact that it's a lot of exports. But this is a very much layman's approach. Our focus is very much on India, and there are reasons for that because of the growth, because of these long-term tailwinds. So we're quite happy where we are. And it's better to do what you know, because what is risk? Risk at the end of the day is not knowing what you're doing. So
Right.
effectively, we don't want it we want to minimize our risk and stick to what we know as good as we can.
All right, Arun. That was a very good answer. So I think we are done. And just a last question for all our audience, and for your fund as well. So generally we say that Nifty will deliver 12-13% over a longer run. That it has done that. We are not committing any return, just on a higher side. We are saying that mutual funds give you around 14-15% on a conservative side. So what kind of alpha you are aiming at to chase in next 5, 7, 10 years? What kind of returns you are chasing at?
Yeah, we haven't got a clue, but as mentioned earlier, we've done okay. Whether it's our AIF, which is 3-year CAGR 30% or so, our FPI is 34.7% over a 5-year dollar CAGR. So far so good. I mean, we're just going to stick to our philosophy, and hopefully, we'll do a decent job. But again, there's just no guarantees. Uh, but hopefully the
Obviously,
philosophy will
it's equity
will last
investment,
the
nothing is
distance.
guaranteed, right?
Exactly.
Right. So thank you, Arun, for being on board, and it was a pleasure connecting with you. So just a last message for all the audience who is watching, that in case if anyone is looking to invest in a portfolio management service or in an alternative investment fund, you can get in touch with us, and we will help you, select some of the strategies which will suit you. So this was all about from the First Water Capital, Mr. Arun. So thank you, Arun, for taking out time and having a call with us.
No, thank you, and hope you have a good day.
Thank you, Arun. Thank you so much.
Thanks. Bye.
Bye.